Hi everyone, hope you're all doing well, and today we're going to talk about a video that I actually made earlier in the week. So earlier in the week I made a video talking about how to build up to a stock market portfolio worth 100k, and mostly it was pretty well received, but there was a couple of questions on it that I want to talk about. Well, one in particular that I want to talk about, which was talking about how important it is if you're building up a stock market portfolio that you build up income coming into your stock market portfolio. Because you imagine you're buying a stock, your stock is probably going to get tied up in that portfolio for the next 2 to 5 years. So you probably won't really release that capital for a little bit. And because you're not releasing that money for a little bit, if there's any more opportunities in the stock market, you need to go buy them opportunities. And you can't buy them opportunities if you don't have cash. So to have cash, you need to be putting money into your stock market portfolio. And I talked about that, what you need to do, or just some numbers that I ran, for example, which was the whole point was showing that if you compound a portfolio with, decent returns, fresh income, is that you could build up a stock market portfolio really quickly. But probably on the video is there's 2 points, which I'm not going to talk about one of them today, which was getting a 10% return every year. So a few people have said that it's actually quite tricky to get a 10% return every year, which I totally disagree with, but I'm not going to talk about that one today. The other one was talking about putting that fresh capital into the portfolio. So on that video, I used an example of putting £500 into a stock market portfolio every month, and over a course of 9 years, you get up to a 100k portfolio. Now, a lot of people talked about how difficult it was to make or put in £500 to a stock market portfolio every month, and I totally understand that. Different amounts of money to different people is very tricky to do. But the main thing that I want to kind of point out, and this goes down to a book, the book is Rich Dad Poor Dad. If you've not read that book, you really need to read that book. It's probably the book that, if you're in high school, in my opinion, we should have pretty much like a lesson about this book, because it's amazing and it changes your mindset about how to make money and also investing and putting fresh capital into that stock market portfolio. And basically, I'm going to go off that book today and kind of talk about what I meant about that in that video. So we need to have fresh capital put into the stock market portfolio. And some people say, there's going to be instances where you won't put £500 in a month. Some things might happen. That's a given. Incidents will happen and you won't be able to put that money into the stock market portfolio. But ideally, £500 was like, if you can, a minimum. If you can put more than that, that's even better. And that's what will help you scale up your stock market portfolio. And this comes down to, as well, this is why I target that video as well when I made it, is to, ideally, if you can do it when you're younger, that gives you an even better chance of performing even better. Because the thing is when you are older or you go through later stages in your life, you're probably going to have financial commitments that mean you will struggle to make up that payment into your stock market portfolio. Whereas if you start doing this and get into good habits earlier on, and this video is basically saying, look, if you're in 20, 25, 30, getting into good habits early on is what will help you a lot further down the line. Now, basically, what Rich Dad Poor Dad comes on to talk about is that basically, if we have, if I draw a chart here, this here is income. Now, when you are quite young, you have a lot of income, or you have a lot of income with a lot less expenses. So if I was to draw a red bar chart on here, this is expenses. So you imagine when you're younger, your income is going to be very high compared to expenses. Now, there'll be certain, I'm going to make this clear because sometimes people go, but. Okay, sometimes, you might have expenses that are quite high. They might be near income. I'm just kind of going off a general point of view here, is that when you're younger, your income will tend to be a lot higher and your expenses will tend to be a lot lower. That means you should have a lot of capability here to be saving, put that into a stock market portfolio. As you go through life, what will happen is your expenses will rise and they will get closer to your income. When you get a lot older, you'll have a lot more financial commitments, like you might go get a mortgage, you might have people that depend on you, and that will rise. And then that's the tricky point of that. When you get to that point, is that you'll have less savings, less money to invest in the stock market portfolio. And that's why really early on, it's really important, while you're kind of not having that many expenses, that you take advantage of that. But as you go through later in life, while your expenses rise, what you want to do is, if you can, is get your income to rise. Now your income can rise from, if you invested early on, that you're taking good returns from 5 years ago, 3 years ago, 4 years, whatever investments you made previously, that will help. Maybe dividend stocks, you bought some dividend stocks, your dividend stocks will help. Maybe as you progress over from being 20 to 30 to 40, hopefully as well your salary moves in the right direction and that helps your income go up, and then you have more capability to go by. Maybe you diversify your income streams and not just have the income stream of a 9 to 5 job. If you have more income streams, that will also help increase your income, so you have more money here to go spend. Now the big problem is this, and this is why people struggle quite often to basically do a lot of this, is that what happens is, and this is massively talks about Rich Dad Poor Dad, is that when income rise, people then increase their expenses, so it gets pretty much level. And basically when people get income rises or pay rises, what they do is they go, oh, I've just got £1,000 pay rise, so you know what I'm going to do? I'm going to go buy that £1,000 TV. Or I've just got £1,000 pay rise, you know what I'm going to do? I'm going to go buy a house. Well, probably not for £1,000, but I'm going to go buy a house, and it's going to be bigger, and the mortgage that I have on the house is going to be more expensive. I'm going to go buy a car, but it's more expensive to run that car. And what people tend to do is they get caught in this cycle where this will rise and this catches up with them, and they just stay level. And what people end up doing is going, oh, if I only had a job that paid me an extra £5,000 a year, and then they get that £5,000 pay rise, and do you know what follows after the £5,000 pay rise? Their expenses. And it's level, and they go through the same process of, oh, if I only had a £5,000 pay rise again, I'd have so much free cash to go do something. But they get that, and then that goes up. And this is the big thing, is managing income to expenses is really the key to scaling up your portfolio, and generally a lot of other things in investment. If you want to invest money, you need to have free capital, and to have free capital, you need to have income that is higher than your expenses, and making sure that when your income goes up, it doesn't follow. Because what you ideally want to do is, through pretty much most of your life, is that if your expenses say roughly the same, or they do slightly creep up, when your income does keep going up, that just gets bigger and bigger, and you have more free cash from your expenses, and you even scale up even faster and faster and faster. And that's the thing, is this is key to do from an early stage, because if you're doing this, if you get into good habits when you're younger, it's a lot easier to do it when you're older. When you're older, if you're looking to get to this point of mindset, because if you're a little bit older and you're kind of in this 9 to 5, and it's just level, it's so hard to carry on growing that, because you have more and more expenses. And that's just the big thing that I wanted to talk about. I wanted to talk about what I talked about on Monday, and just say that, like I said earlier, Rich Dad Poor Dad is a great book to kind of get this mindset. But this is why it's so important to do this actually earlier than later, because while you're kind of not having them expenses rise, the more you build that up, the quicker it will happen. And then when your expenses do start to happen, when you do get older and go through life, you're still going to have so much free cash. If you add in a mortgage, you have people now depending on you. You kind of, you're ahead of the curve, and that's the big thing, is planning ahead. So I wanted to make that video talking about that, because I feel like what I said about that £500 a month, a few people didn't really agree with that, but I understand that it's different for every situation. I'm not saying this is the ideal situation, this is the dream situation. There's going to be people that for some certain reasons that might happen in their life, they might be at a disadvantage right from the off. When they're a lot younger, they might have that going on. But I'm just saying that more than likely, when you are younger, your advantage to get started is a lot better, and is the time where you can actually help yourself get off to a good start and not really fall behind, I guess. So yeah, I just want to talk about that, and like I said, the Rich Dad Poor Dad situation, where the big thing is to scale up your portfolio, is putting new cash in, and as well as that is that to do that, manage income and expenses and make sure your income is staying ahead of your expenses. Don't keep it level, because if you keep it level, that's where it does get tricky to kind of put them new cash injections into your stock market portfolio. And it is easier to start that from an early age, start that early on, rather than it being later on in life when there's probably a lot more expenses and a lot more things that could potentially go wrong with them expenses as well. So hope that was useful. Anyway, I just wanted to clear that up, and hopefully it was useful, and especially if you're in the kind of earlier stages of investing, hopefully that kind of clears it up with getting started early definitely gives you a massive advantage. So if you could, smash the like button. If you're new, subscribe, and I'll see you next video.